Hey everyone, welcome back to Corporate Decoder, the place where we peel back the curtain on corporate filings and find out what is really going on behind the scenes. Today we're looking at MSC Industrial Direct Company, Inc., and a recent update that might seem a bit dry on the surface, but trust me, it has some interesting implications for how they manage their money. We're diving into their Form 8K, which is basically a report for when important things happen that shareholders need to know about. Fast, this particular filing is about them making some changes to a deal they have to help them get cash from their sales, a process called receivables, and guess what? It involves millions of dollars. Alright, so what we're looking at here is an amendment to something called a Receivables Purchase Agreement, or RPA for short. Think of it like this. MSC Industrial Direct has a lot of customers who owe them money for parts and supplies. Instead of waiting for all those customers to pay up over time, they can sell those promises to pay, called receivables, to a bank or other financial institution. In return, Mississippi C gets cash much sooner, which they can then use to run their business, buy more inventory, or invest in other areas. This amendment is important because it does a few key things. First, they've extended the date when this deal is supposed to end. It was set to finish earlier, but now it is going to continue on until December of 2028. This is a good sign that the company and the financial partners involved are comfortable with the arrangement and see value in keeping it going for a longer period. This is a big one. They've added a new buyer to this deal, and that means the total amount of money available through this receivables program has gone up. It is now $350 million, an increase of $50 million. This tells us that MSC Industrial Direct is looking to access more immediate cash. It could mean they anticipate higher sales, greater need for working capital, or maybe they are less reliant on traditional bank loans for this part of their financing. Another change is the removal of something called a credit spread adjustment. Without getting too technical, this adjustment likely made the cost of borrowing through this agreement go up or down based on certain conditions. Removing it suggests they've locked in a more stable cost of funds for this facility. It simplifies the interest rate calculation and potentially lowers the overall cost if that adjustment was adding to the expense. They also updated how they calculate their consolidated net leverage ratio. This is a measure of how much debt a company has compared to its earnings. By updating this definition to match changes in their main bank loan agreement, they are making sure their financial reporting stays consistent. This is good for transparency and helps investors and lenders get a clearer picture of the company's debt situation. Now, while this filing doesn't contain detailed financial statements, the changes to this receivables purchase agreement are a financially significant event. The increase in the available funds and the extension of the agreement point towards a company that is actively managing its cash flow and securing predictable access to capital. Think about it as having a readily available credit line, but instead of using it for general loans, it is specifically tied to the money their customers owe them. This flexibility can be crucial for a company like MSC Industrial Direct, which deals in a vast array of industrial supplies. Imagine needing to stock up on a massive quantity of specialized tools or equipment. Having quick access to cash through receivables can make that purchase possible without disrupting day-to-day operations. It is also worth noting who is involved. Wells Fargo is acting as the administrative agent. They, along with Bank of America, are also lenders in MSC Industrial Direct's main bank loan or revolving credit agreement. This kind of overlap isn't uncommon. It shows a strong relationship between the company and these financial institutions, which can be beneficial when navigating complex financial arrangements. It also means these banks have a deep understanding of MSC Industrial Direct's financial health across different aspects of their business. So, what does this all mean in the bigger picture? Well, for MSC Industrial Direct, it signifies a strategic move to bolster their financial flexibility. By increasing the size of their receivables facility and extending its term, they are essentially strengthening their ability to manage short-term cash needs. This is particularly important in the industrial supply sector, where inventory management and timely delivery are key competitive advantages. If they can ensure they have the cash on hand to buy what their customers need, when they need it, they can maintain customer loyalty and capture market share, even during fluctuating economic times. Now, looking at these numbers and what they represent, this isn't just a minor tweak, it is a significant increase in their access to funds from their receivables. This $50 million jump to $350 million means they have a much larger buffer. It could be used to finance larger inventory purchases, smooth out cash flow during seasonal demand shifts, or perhaps even support strategic acquisitions or other growth initiatives down the line. The extension until 2028 also signals a level of confidence from the financial partners in the company's future performance and its ability to manage these receivables effectively. From a Warren Buffett style perspective, we're always looking for a company that understands its business and has a clear path to profitability. While this filing doesn't give us the full financial picture like a 10-K, this amendment to the receivables agreement tells us that MSC Industrial Direct is diligently managing its working capital. They are ensuring they have the liquidity to operate and grow. The fact that they are increasing this facility suggests they see opportunities, and they want the financial runway to capitalize on them. It is about having the cash to either weather a storm or seize a growth opportunity. In conclusion, this filing, while technical, reveals a strategic financial maneuver by MSC Industrial Direct Company Incorporated. They are enhancing their access to capital through their receivables, demonstrating a proactive approach to financial management. This move is likely intended to provide greater operational flexibility and support future growth. The increased commitment and extended term signal confidence from their financial partners and a commitment from MSC Industrial Direct to robust cash flow management. Alright, that is our breakdown of MSC Industrial Direct's latest filing. What is your take on these financial moves and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching, see you next time.